Hi, my name's Danny Callow. I'm the President and CEO of African Gold Group, a TSX-V listed developer and explorer. I'm also joined on the call with Uwe Engelmann. He is a consultant geologist and the Managing Director of Minxcon, a company that we've been working with for 2.5 years now on the KOBODA gold asset in southwestern Mali.
Danny, Uwe, good to have you on the call. Good to see you today. I'm really interested about African Gold Group. When I was preparing for this meeting, I was pretty impressed by what you've got going there. I was also quite struck by your share price, which is stubbornly low. Could you just give me, before we get into kind of the technical side of things, could you give me a quick overview of how the market's treating you, kind of what your interaction with is of the market at the moment? What are people saying to you?
Yeah, so thanks, Merlin. I think just to step back one step, I've been involved in the company for just over 2 years. I joined in August of 2019. We inherited a legacy company that had been around a long time, and that company had done a fair amount of exploration within this KOBODA asset. One of the things that I noticed was that there really hadn't been a huge amount of focus on the technical side. I come from a large corporate background, Glencore, Goldfields, those sorts of companies. And the one thing that I've always found critical is that if you want to stand on a platform and talk about your asset, you need to be able to defend that from a technical perspective. So we've spent just over 2 years really firming up on the technical side of this asset, which has resulted in obviously updated resources and reserves, but also an updated definitive study. Sadly, you know, a company like ourselves, which is effectively a development company that's delivered an amazing resource reserve over the last couple of months, you know, the question that comes from most investors is, okay, great, you've done the technical stuff, you have a great asset, you have a great project that can be built. Where are you going to find $165 million to build it? And there's always that sense of I guess caution from investors around what are they going to do next. You know, are they going to dilute everything out of the equity to raise the money? Are they going to be able to find the debt to raise in a project in southern Mali? And therefore, basically, we're in this sort of holding pattern where we have a huge amount of interest from investors that see it as a great asset. Everything from the definitive study has been very positive coming back from the investor community. I think there's just a little bit of a wait and see to see who's going to put their toe in the water first and put the first sort of cornerstone investment in to move this into a construction phase. And obviously, with our current market cap, as you mentioned, it's very difficult to go to equity holders and ask them to put their hands up first. So we've been talking predominantly to debt providers. Ultimately, large-scale debt is the best way to go because it's reasonably cheap compared to mezzanine debt. But we see that this would be a combination of both large banks and mezzanine providers that would provide the debt portion of the raise, and then we would go back to the equity side and top it up with the equity side. So,
but hang on, yeah. Sorry, just let's not get into the debt side of things. You've just done a capital raise. You've just raised 5 million. Yeah, sure. And when you were selling that, surely you were using the kind of the comparable analysis to say that we are much cheaper than our peers.
Yep.
You know, what do you see what do you see yourself trading at on a per ounce basis?
We're on an EV to total resource, we're probably at around $6 an ounce compared to our peers at upwards of 60 to 70. EV to total reserve, probably 10 versus our peers at maybe 100, 150. So clearly, you know, this is really showing that we are undervalued.
There's a massive disconnect. There's a massive disconnect because you've got resources and reserves. You've got a feasibility study. These are oxide ounces, free dig at surface. So there's when I first called around, I said, "Well, I've got friends who know West Africa very well. I haven't spent a lot of time in the gold sector of West Africa in the last 6 months or the last 12 months, but I said, what's the story with African Gold? And the feedback was, oh, it's a Forbes and Manhattan company. It's got that legacy thing. But I went through your MD&A, and you've got zero liabilities and zero connections there. So in a sense, that's clean.
Yeah.
Is that correct?
That's 100% correct. And that I guess is the slight frustration. We've been through a process from late 2019 of effectively divesting all of our liabilities and responsibilities with Forbes and Manhattan, including removing all of their historical board members from the board, cancelling and terminating all consulting agreements with Forbes and Manhattan, cancelling office services agreements. And in March of this year, we effectively emerged as a very clean company. Unfortunately, I think that there is always this overhang of the market perception of what's happened in the past. And it's really just getting that message out there that we are 100% free from any prior Forbes and Manhattan relationships. The only thing Forbes and Manhattan have is a small shareholding in African Gold Group, which it makes them a small shareholder, not a medium or a large size shareholder. And we've even had a very good success in divesting what was predominantly a Canadian and North American shareholder base to much more global. So we now have European, London, and a fair amount of Australian investors on board. So I think that the message that we really should be getting across is that we are 100% unencumbered. We have no liabilities. Our balance sheet is clean. We have no relationship or anything else with Forbes and Manhattan. We've done a very good job in cleaning all of that up over the last 2 years. But I think, as you rightly say, there tends to be this legacy thing that people think of the past, and they think, oh, that's a Forbes Manhattan company. So I think that has dragged us down. I also think that a single asset in Mali is also perhaps discounted more than if you have 2 or 3 assets around that spread the risk a bit. But again, we can talk about Mali. I've worked in Congo, I've worked in Zambia, and if you gave me a choice, I would work in Mali before any of those countries any day. So, well,
you're not alone. Mark Bristow always preferred he always says that the francophone countries of West Africa is where the laws are clear and it's much easier to operate and maintain title. He did eventually, of course, with Rangel go into the DRC, but I think by preference he would have stayed in francophone West Africa. And Mali's got a superb track record of responsible mining at an industrial scale in the south and the west of the country. Yeah. I'm not worried about being a single asset company. When you're not in production, it's very sensible to focus on your lead project when it's quality and it's got scale. In your presentation, you list 4 kind of institutional shareholders: Ixios, Nero, L1, and Pala. Have they been? Are they new? Did they come in this most recent placing, or have they been? Are they supporting? Are they following their interest? Are they adding? What's the institutional support like for the company?
Yeah, the institutional support has been really good. I think we've gone from around 8% institutional support pre-July 2020 to close to 40% now. We've seen all of the shareholders that came in that big raise that we did last year, July, August, of around $11 million. All of them came in on that raise. All of them have continued to support us and remain as very supportive shareholders, with a view that this will go into a construction and operation phase. So I think we've done a good job in communicating with institutional shareholders. We've certainly seen a lot of interest out of Australia, and I think the Australian investor community understands West Africa very well. They understand there are some risks, but they understand that there are rewards there. And we've seen a big uptake in the last 2 raises of Australian investors coming into the stock and remaining in there and continuing to support it through volume in the screens.
Danny, thank you. And I'm sorry, I know this is supposed to be a technical interview, but I needed to understand the corporate background. I needed to understand that shareholder register so I could just put the technical side of things into context. So, and Uwe, I'm not going to get to you yet, but I'm going to still stick with Danny and the study. The feasibility study, Danny, you're looking at 100,000 ounces per annum, and you've reduced the capex of the project. I can't remember what it was in the previous study, but you've reduced it to $165 million. Can you just tell me how you've managed to reduce that capex, and what areas were the reductions in the costs?
Look, the actual number hasn't reduced; it's gone up slightly. But what it has done is brought in around another 500,000 ounces of sulfide reserves. So what the big difference between last year and this year was, we focused heavily on bringing in the additional exploration holes that we hadn't managed to include in the previous study, and that was mainly in the oxides. We also then brought in all of the sulfide resource that was sitting in M&I that we could bring in within the existing pit shell, by making sure that we did a very comprehensive test program. So this latest study is really showing a highly flexible operation that can treat oxide sulfides, it can treat a mixture of both. Predominantly, as you mentioned at the beginning, oxides for the first 7 years, free dig, almost no blasting, very straightforward, very easy open pit mining through a very simple crushing, milling, gravity, through to CIL and electric winning and furnaces. And then obviously what we do is we bring in the sulfides, which happen to be free milling and can also be treated through exactly the same process in year 7. So what you're seeing is a little bit of a juggling with the capital. So very similar up front, a little bit more in year 6, where we have to bring on an additional crushing and milling plant for the sulfides. But ultimately what we've done is we've proven that this is a mine that can now treat all of the oxides and sulfides on our property. There's no surprises anymore. Which I think was a little bit of a question mark from last year's discussions with investors. Why are you not tackling the sulfides? Now we have this very flexible plant that can treat anything. We can throw a mixture of both at it. And we've also pushed the production out from 100,000 ounces for the first 5 years to 100,000 ounces for the first 10 years. So we really are seeing a mine now that is stable at 100,000 ounces a year for 10 years. It has a 16-year mine life. And it has this massive exploration upside, which I'm sure we're going to get to talk about, where we know that we're going to fit in those last 6 years with additional ounces without any problem whatsoever. So I think capital-wise, if you have a look at us in terms of capital cost per ounce of gold, we're way down on the cost curve. We've kept it very lean and mean. We've used a company that have done 11 or 12 of these plants in West Africa called Sanity. They've just delivered one across the border 60 kilometers away at Trike, which is a very similar plant. So we know the capex is good. We know we can defend those numbers, and we know that we can deliver that plant in 19 months from start of construction. So I think that we've really spent a lot of time on these studies, firming up the numbers to the extent that I can sit here today very confident that we will deliver a $165 million plant producing 100,000 ounces of gold.
Just to be controversial perhaps, but given that you've got 3.4 million ounces in your resource base and you've got all of this exploration potential on the shear, is it possible that the correct way to approach this development should actually be 200,000 ounces a year or 250,000 ounces a year? I mean, if you were a big company, would you step back and say, hang on, let's think about the resource base here and let's make this a top tier or kind of top quartile asset capable of producing 250,000 ounces a year for 10 years? Is that a luxury you don't have, but you kind of dream about sometimes in the bath?
Yeah, I do dream about a lot of things in the bath, and one of them is sort of further optimization of the study, and that is something that now with our current raise just completed, we have a little bit of flexibility to be able to look at that. Take someone like Tieto, for example, in Côte d'Ivoire, their Abuja project. I think they've just come out with a study that's pushed their production number up quite significantly to more than 200,000 ounces. We will have a look at all of those things, Merlin. I mean, you know, we're a 3 million tons per annum plant. A 4.5 million tons per annum plant would theoretically give us 150,000+ ounces a year. I think when you listen to what Uwe's got to say, the upside potential in terms of bringing more ounces in, it may not be at a higher grade, it may be at a similar grade, but it will certainly be a significant amount more ounces. Obviously, it doesn't make any sense to plod along at 100,000 ounces for 20 years. So we would have to go back and have a look at optimizing that for a slightly larger plant. A 4.5 million tons per annum plant is not big in West Africa these days. It's fairly standard. It's almost an off-the-shelf plant if you have a look at some that are going in now. And I think that's something that we would really have a look at. And we have that flexibility now because we have a nice healthy cash balance, which is always good. And we can start to do some of those other studies that would potentially push that 100 up to probably comfortably 150. I wouldn't want to commit to any more yet. But obviously then we would have to get back the drills back in the ground and get some more ounces in the back end to be able to make this I've always worked on the assumption that you want a 10-year life to give you the flexibility to build the plant, get it into production, and then still have enough time to continue to explore and back up some more ounces on the ones you're producing. Anything less than 10 starts becoming a little bit shaky because you generally don't have enough time to drill, upgrade the resource, upgrade the mine, and then continue to add ounces to the back end. But 10 years at 150,000 ounces, in my opinion, is very feasible on this deposit. And it's just a case now of starting to do some of those economies of scale studies, which will certainly give us more benefit on the capex, and it will certainly give us more benefit on the operating cost. And
crucially, it will give you more leverage in the market, because when you're a 200,000, or I keep coming back to 200,000 ounces, but I'm dreaming big. But 150,000 ounce with flexibility on the upside, that gives you just that much greater weight and impact in the market, and you become more relevant to the kind of a bigger peer group, kind of a larger market cap peer group. So let's go to the geology. Uwe, you're on.
So let me just. Shall I share this? Do you want me to share the screen and just put a couple of slides up? You can pull them down.
Yeah, please do.
Okay, so just jumping into the overall geology, I suppose you're very familiar with it. As you can see where it is there in the center, the KOBODA, that hammer there, 3.1 million ounces there. You can see it's sitting within the Birunian belt in West Africa, where most of the gold mines of West Africa are lying in Ghana, in Cote d'Ivoire, or Mali. So yeah, the address, a perfect address. So I don't think there's any debate about are we in the correct address in that respect. Okay. So just a bit more, we're sitting on the West African craton there. So it's like I said, it's in the Birunian, on the Man Shield. In our case, we predominantly metasediments. So we generally speaking, we in the grey wacky siltstone, mudstones. We have intercalated volcanic sediments, but not too much of that, because we're sitting on the border of the Siguri Basin and the Janfelila granite greenstone belt. So if you go more to the east, you're basically going into the granite greenstone belt, and we're more in the Siguri Basin. So whereas Janfelila to the east of us, they're sitting in that greenstone belt, and like I said, we're in the Siguri Basin, basically more in the metasediments. Our deposit is really associated, or the current one where our current resource is associated with the main KOBODA shear zone, as it's been termed over the years on the project, which has got the north-northeast main trend, which is similar to a lot of the mines that you can see in one or two of the slides later on, that the upside potential within the boundary of the permit area, or the 3 permit areas, they all got very similar orientation as the one that we've got in the KOBODA shear. Okay, Danny.
Is the mineralization? Oh, here we go.
So it's orogenic, mesothermal, pretty much being the shallow to medium to shallow, mesothermal, and definitely within the compressional, transpressional deformation processes, where the fluids come from deep-seated fluid, the hydrothermal fluids come up and utilize the pathways within the structures in these areas, and as they rise up, they precipitate out when they start getting the correct geochemical and the temperature and pressure domains basically coming through there. So it pretty much is I'd say, a stock standard orogenic mesothermal gold deposit. I think where the upside, or what's nice over here, is that it's in what we've turned, and I think that's on the next slide, Danny, is it's sitting on a dextral shear that includes or has also got Riedal shear structures and features. So when we started developing the model back in 2019, we collated all the historical data that was collected over the years and started putting it into the Leapfrog, because there was very little structural information available. And I suppose one of the problems over here is that it's so deeply weathered, is that we can't, or we really struggle to orientate any kind of core in the saprolite. So it's very difficult getting accurate structural readings in the saprolite, where the predominantly, or where the majority of the resource is sitting. So what we did is we went into Leapfrog, and we started using implicit modeling there, having a look at the trends that we picked up, or could pick up from the data, and some kind of domaining. So we normally generally start with the ISO shell without any kind of direction, just to see what we start picking out. And what we then put together, and there is a slide a bit later that actually shows what the final outcome was of this, the modeling process, where we had a couple of iterations looking at the different orientations of the shears and the veins that we were picking up in the historical data. So what came out of there, we had a model that we were fairly happy with, and then at some stage, I can't remember exactly when it was, Dr. Andy Rompel joined AGG. He's a structural geologist, and in conjunction with him, we basically, so this is our conceptual model that we put together. It's a dextral shear with a Riedal system in it, where we've got the synthetic and antithetic shears. And I think that is one of the nice things over here, where it makes, there's a wide lower grade ore body in relation or in conjunction with the higher shears that we've got coming through. We've think it's a more of a compressional area where we are, and that the more east-west trending shears that we've got are extensional gashes, which generally speaking seem to have a little bit higher grade, but not that much more. So if you have a look at the shears, or the orientation of the veins and the shears that we've picked up, it's basically almost every compass point gets mentioned, kind of thing. So you can see the synthetic and the antithetic zones coming through, and within that area, you've got the higher grade quartz carbonate veins, and it's a combination of veins, veinlets, multiple veinlets, stockwork, and it's the areas where you got a higher network of the synthetic and antithetic veins coming through that you get the juicy part of the actual ore body. But just to sum off on this one, you can see on the right there, the main KOBODA shear, which, like I said, all the other shears are basically run parallel to that, and the main direction being the north-northeast direction, which we can also see going from our project into the Cora Gold project, where they're busy doing press releases, and it seems to be part of the same kind of system coming through. And then the other main, I suppose, direction is the east-northeast, which is more of the east-westerly synthetic veins that are coming through there. And you'll see in one of the photos a bit later, where I think it kind of shows it quite clearly, or quite nicely, the upside, or I think which is a very positive or nice thing about the KOBODA project, is that it's a wide ore body that you can have low or lower stripping ratios, and your waste that you need to get to the higher grade is actually carrying grade in that respect. So you can have a look at different mining method or mixes, where you got the low grade stockpiles, which I think is what's been brought into the whole mining design, where one can then play with that. And if one does get another shear zone a bit later, have the high grades there and mix it with some of the old or stockpiles that are lying around. So the options are there from that point of view. Okay, Danny?
Let's move on. But is the is the mineralization in the fractures, or is there any kind of bleed into the sediments? What's the porosity and permeability of those sediments, the meta sediments? Are they quite impermeable and brittle? And is the gold on micro fractures, or is it disseminated through the host rock as well?
Majority of it is in the actual fractures, and that's what I'm saying, where you've got the really juicy part of the ore bodies, where you've got a higher network of these veins coming through. But so the photo that you see on the screen now kind of shows the laterite and the saprolite. But the point I'd like to make over here is you can see it's not like the artisanal mining in a lot of the greenstone belts, where they follow the thin 0.5 meter to meter shears and they just take that out. You can see that they actually mine everything out there. And I think that's the nice thing about this ore body. It's free digged in places down to 160, 180 meters. And if there wasn't grade in the surrounding material, the artisanal miners wouldn't be mining in it. When you're on site and you see them panning it, there's also areas that don't have any of the vein material, and they're picking up free gold within there. So there must be some of that leaching going on in there, but primarily it is within those shears and the veins, basically. Within, and like I said, from what we picked up, it's in all of the directions, basically.
So you're essentially saying that you've got a fracture network within a sheared fabric, or a kind of sheared belt or a zone, and that there may be some dissemination due to weathering or meteorological processes, surface enrichment or surface distribution, remobilization. Okay, great. Let's crack on. So
there's just a quick. So you got the usual laterite, saprolite, and the previous one there was just showing the actual mineralization, the mineralized ore body. Moving on to the overall concession. I mean, we've got the three concessions. We've got the main KOBODA one. Then you've got the one up north, the Faraba, and then the KOBODA East, or as it's called over there, is the KOBODA Est. And there you can see the open pit at the KOBODA shear. I don't know, Danny, if you could maybe just show where the open pit is. So that open pit, that's the 4 kilometer strike that's sitting in the current resource. So if you have a look at that from an overview, you can see only a very small portion of the 55 kilometer potential shear is actually finding its way into our current resource. So the other is still the upside potential. The only other area that's really had any kind of drilling done to it is the Gossa, and there we've also only got around about 21 balls or so. And what we're picking up there is that the grade is very similar to, and the grade as well as the actual geological features that we're seeing there, the veins and the stockwork and all the rest of it, looks very similar to what we're picking up in the KOBODA shear. And that area around about now we don't have it in a resource yet, but we can see that the mineralization is around about 750 meters long in strike. And some of the next drilling that we're going to be doing will be for additional infill and then stepping out to have a look at what's going over there. So there, the overall mineralization is slightly thinner if you look at the overall shear zone, so to speak. But the grade is very similar, if not slightly higher by the looks of things than what we're getting at KOBODA. So the next step now would go and do some RAB drilling or auger drilling on some of the other areas or target areas that we've got.
I think just to add into that, I think that in the last 2 years we've had a very strong focus on really defining a resource that is economically viable to mine, so a reserve, and all of that drilling then really has been focused around this very small 4 kilometer area, which has given us this 1.25 million ounce reserve and 3.1 million ounce resource. As Uwe says, we really did some step out drilling just to test the continuity on this Gosso shear, the green one there. We've done very little drilling anywhere else on this property, but we're very comforted by the fact that there is continuity through these shear zones from historical artisanal workings. And again, I think people get a bit nervous about artisanal workings. For me, it's one of the best indicators of gold in the ground. Most artisanals can only really mine down to maybe sort of 10 to 15 meters in that saprolitic material because it's very soft. As Uwe says, we've got material down in places to 180 meters of saprolite. So clearly, the dilution from artisanals is very minimal on the overall resource, but it is a great indicator of where we should drill next. And in the 20,000 meters of drilling that we've done since I've been involved, without sort of blowing our own trumpets, we pretty much get a hit on every single drill hole. And the reason for that is because we have a very good understanding now of where those shear zones run, partly because of some of the artisanal workings, but also because of the regional geology that we've layered on top of each other to go and find those. So, for example, recently you would have seen some press releases from this whole KOBODA Est and Phi shear down here in the corner. That is the one, as Uwe says, that really sort of translates through into the Cora gold properties, where they've come out with some pretty good grades and resources. And then the Gosso shear here, where we've only delineated about 750 meters of what we believe to be 10 kilometers of strike, but already that is shaping up to be something that could be easily converted into an indicated resource with a bit of extra drilling. So, you know, in summary, without belaboring the point, this is 250 square kilometers with 55 kilometers of shear zones, of which only 4 or 5 kilometers has actually been drilled to develop any sort of resource. And, you know, away from prodding holes, you know, across 20, 30 kilometers of strike just to prove the gold is there, we've been very disciplined on bringing this thing into a project that can be built. I think, you know, and we can talk about it, the next steps are to start to test some of these shear zones a little bit more, to just make sure that the continuity that we believe is there. And suddenly then it starts to shape up to be something, as you mentioned, Merlin, that could be a 200,000+ ounce producer by delineating some of this into a measured and indicated and obviously a reserve. And
are there artisanal workings down all of those 4 shears?
Yeah.
Including because the only one you haven't mentioned so far is KOBODA East. Yeah. And has that also got artisanal working on it?
Yep. Yeah. So what you find with the artisanals is there's obviously they target outcrops. The laterites are attractive to them, not because they're easy to dig, but because the walls stay up. The laterites tend to be 8 to 10 meters deep, or 6 to 10 meters deep, and that's where they find some of this nuggety gold that is easy to pan out and produce gold quickly. And the saprolites is a little bit more difficult unless they can actually find some of the quartz areas. But yeah, I mean, there are literally pits all the way along those shear zones, which effectively overlay all of the regional geology that we've added and layered on top of it. So, you know, you can put a drone up and literally follow that shear zone all the way through all of those exploration areas. It's fairly straightforward.
I think it was actually the following slide, or the next slide, Danny, that actually has got some of the KOBODA Est. Now that you mentioned the KOBODA Est, so if you want to have a quick look at that, that just goes to show some of the artisanal mining that we've got there. So we were starting to, as an initial just recce, just to start looking, can we put some trenches in and so forth. I think it's next one.
There's KOBODA Est. Is that the one you're talking about?
Yeah, next to there we go. So there you can actually see. So those are just some examples of what KOBODA Est is looking like, which is very similar to what we're seeing in Gosso as well as at KOBODA. So you can see in the top one, which is one of the pits, so we just got photos of 2 of the pits here. It's a combination of, in some areas you've got the top left, where you've got the stockwork kind of material. Then you go into the one in the top middle, which is more of a wider zone coming through. And the bottom one as well, wider zones. The bottom right, you can see it's almost like a brecciated zone coming through there at times. So it's a whole combination of is it like a meter or 2? 1.5 to 2 meter vein coming through, which one gets down to a stockwork and this kind of material. And I think that's the beauty of here, is that your waste is pretty much carrying grade here that you can utilize at a later stage for stockpiling, for mining mix, basically, and your grade mix.
Great. Uwe, thank you very much. Are there any other key highlights you want to make on the geology bit? I've got a couple of other questions before we wrap up.
I think that from a geological point, I think that pretty much sums it up. The only one maybe is the model, if you wanted to have a look at that we've got in there, that we basically our final model after all the iterations we've done, which was tested then with that 18,500 meter drilling. So the drilling, the phase 1 and phase 2 drilling was a recommendation to confirm some of the historical data, but also confirm the new model that we've got. And I think that's why we've got a fairly high confidence in the model, and happy to put it into M&R the way we have, is because of the confirmatory drilling that was done that actually spoke or actually confirmed the model that we had actually put together from the geophysics and the data and leapfrog and so forth. So, yeah, I think from a geological point of view, that's pretty much a wrap.
Great. Well, Uwe, thank you very much. I've got 3 questions. Did you look at heap leach for this?
Yes, we did. What we did was when I joined in 2019, I had a look at the studies that had been done before. They certainly, maybe I'll just be diplomatic about that, they were not to the standard that I would expect for a project that had been in and around for so long. So what we did was we took representative samples across the ore body, either from core, and we went back and we tested everything again. So we tested heap, we tested gravity, we tested gravity plus CIL, and basically the challenge with the heap was that because the gold is fairly finely disseminated, the cost of agglomerating that to put it onto a heap was about, you would almost have to put a cement plant next to your process plant to be able to agglomerate. It was about 200 kilograms a ton. And the problem as well with a heap is that a 15-meter heap, if you can't agglomerate it properly, as the pressure comes on from the fluids being diluted down, those agglomerated particles collapse, and then you get pooling and all sorts of stuff that don't work very well, as you know. Gravity, which was the preferred method when I joined the company, was done on a very unrepresentative sample of part of the ore body that did recover very well through gravity techniques. And not surprisingly, that study was done by the supplier of gravity equipment. We did test gravity. We only saw about 28% recovery through the gravity process overall across the ore body. But that's good enough to be able to put a gravity plus ILR in there. But CIL was really the only way we could recover around 94-95% of the overall gold. And the challenge with mining a fairly low grade ore body, even though these days 0.9 to 1%, 1 gram a ton is not that low grade, is that you want to get as much of the gold out as possible if you've gone through the whole effort of getting it out of the ground, stockpiling it, blending it, and putting it into a plant. So for us, it was a good exercise to make sure that we were choosing the right processing option going forward. And we've tested that on numerous occasions with additional variability test work. And every time that is coming out, gravity plus CIL as the best way to go. Good.
Thank you. I also noticed that in one of the appendices to your presentation, you've got a section on global AISC costs at kind of whatever it is, $1,200 per ounce. And yet your anticipated AISC is, remind me, it's
at 970, I think.
970. Why do you include that global slide? Is that and are you going to meet the benchmark, or what gives you the confidence to be below the benchmark?
Well, look, one of the reasons why it's in the appendix is that I don't think that's something that you brag about when you're still a developer and not a producer. And we're obviously benchmarking against producers that have physical costs. You could also argue that some of those producers will calculate things in a different way. So it's a little bit of a subjective slide. However, I think the reason for adding something like that in is that, and you will see it through this year now, as most of the producing gold miners are reporting, you're seeing a fairly large jump up in all-in sustaining cost numbers from last year. Now, that's a number of reasons. I guess it's a lag of impacts of COVID. It's the global steel price. Remember, iron ore was way over $200 a ton most recently, and that's still impacting steel costs. Fuel prices almost doubled since last year. So a lot of your input costs in terms of building the plant and operating the plant have gone up significantly. So I think it was really for us a sanity check to make sure that at 972 we were not out of the park here. Can we achieve that? Well, I think we will say yes, we can, because the way we've calculated those inputs and the capital costs are from firm quotes for delivery, and that is 2021 prices. So we're not having to add escalation and things like that into that. but there are continuing inflationary impacts, as we've seen through most of the first world countries that are producing a lot of this stuff. And, you know, we will do our best to keep to it. But yes, we can certainly show confidently that the calculation that we've made to get to that number can be defended by firm quotes from suppliers, and very up-to-date costs from mines in and around us for things like security, transport, logistics, and other, I guess, non-quotable or non-sort of firmed up numbers. So I think I'm pretty confident that we can hit those sort of numbers and possibly even beat it, by being a little bit clever about how we build this plant and operate it.
Good. Thank you. It's nice to hear people talking realistically about industry costs and the difference between the forecast costs of a study relative to, oh look, we're going to come in below the benchmark, significantly below, when there's actually a real world example out there. So it's good to hear you talking about that. Now, before we go, just the last thing is, you said that your capital raise has given you a little bit of extra time. It's bought you a bit of extra time because you've got the some more treasury. So can you just kind of remind me what you're going to be doing over the next 6 months, 8, 9 months, as your kind of your plan of attack in terms of operations and studies, and what you'd be really looking to do?
Yep. So very simply, our 2 exploration concessions, which are to the north and the south of our mining permit, were renewed in August of this year, which was great news for us. So we have 3 years additional time on those permits to decide what we want to do with them. There are obligations from the Malian government to spend a certain amount of money on those to continue to keep them active. We've done most of the, I guess, the easy stuff on those concessions now. We've delineated the shear zones. The next step is we have to do some drilling on those. So there's certainly some budget in there to do drilling on the exploration concessions. We're toying with ideas of putting a drill back in and seeing if we can convert some more of the inferred resource within the current pit shell into measured and indicated. But again, the trade-off there will be, you know, if we're going to go from 1.25 million ounces to 1.35, is it really worth spending that money right now when we've got plenty of ounces to get going with? And then there's obviously these additional studies, and you hit the nail on the head by saying now that we have a very strong technical base, and we have all of the information from the geology side, a good understanding of the structural geology and a good understanding of the model, we should be starting to run some scenarios now on bigger plants, smaller plants, and what can we get out economically for the best bang for our buck. So we'll be doing some of those studies with our engineering partners over the next 6 months or so as well.
Danny, thank you. That's a really good summary. I look forward to following the news. Uwe, good having you on board. I look forward to the next one.
Thanks, Merlin. It's great to chat.
Thank you.